Gold was on a roll, until it wasn't. As we reach Friday the 17th of July, 2026, the precious metals recovery momentum has come to a grinding halt, and analysts at Commerzbank are pointing the finger squarely at the United States Federal Reserve. Despite a promising run earlier this month, gold buyers have pulled back sharply, rattled by the Fed's persistently hawkish tone and the deepening uncertainty over when, or indeed if, meaningful interest rate cuts will materialize. In a market where every word from a central banker can move prices by tens of dollars per troy ounce, today's widespread caution is entirely rational. Gold is not collapsing. It has not broken down technically. But it has stopped climbing, and that pause is telling us something important about the balance of power in global markets right now. The question is, what does this mean for your portfolio, and where does gold go from here? Stay with us, because the answer is considerably more nuanced than the headlines suggest. To understand why gold has stalled today, you need to understand the Federal Reserve's current posture. The Fed has made it abundantly clear through recent communications that it is in no hurry whatsoever to cut interest rates. Inflation in the United States, whilst having retreated from its earlier peaks, remains stubborn enough to keep policymakers firmly on high alert. When the Fed holds rates at elevated levels, it increases what economists call the opportunity cost of holding gold, which is a non-yielding asset. In plain English, investors can earn meaningful, reliable returns simply by holding U.S. Treasury bonds or money market instruments, making gold comparatively less attractive as a destination for capital. Commerzbank's analysts have highlighted this dynamic explicitly in their research published today, the 17th of July, 2026. The bank's position is clear: as long as the Fed maintains its hawkish rhetoric and resists any pivot towards accommodation, the path of least resistance for gold remains tightly constrained. Any significant upside move would require either a decisive dovish shift from the Fed or a sharp, unexpected deterioration in U.S. economic data, and neither appears imminent as things stand. Commerzbank's research desk has become one of the more closely watched voices on precious metals throughout 2026, and their assessment published today is measured but decidedly cautious. The bank acknowledges that gold has shown genuine resilience over recent months, particularly against the backdrop of geopolitical tensions and consistent central bank buying from emerging market nations. However, their core argument is straightforward: the Fed's hawkish outlook is functioning as a hard ceiling on any sustained rally. Commerzbank's analysts specifically point out that gold buyers have become increasingly tentative, unwilling to push prices meaningfully higher without a clear and credible signal that U.S. monetary policy is genuinely about to shift. This is not outright bearishness. Commerzbank is emphatically not predicting a gold crash or a sustained sell-off. Rather, they see the market entering a consolidation phase in which prices move sideways whilst investors wait for greater policy clarity. Think of it as a holding pattern, and one that could persist for several weeks yet if the Fed continues to send mixed or unambiguously hawkish signals to financial markets. It is worth stepping back and examining what has changed in recent weeks to bring us to today's stalemate. Gold did mount a creditable recovery earlier in July 2026, supported by a combination of U.S. dollar weakness and fresh demand from central banks across Asia and the Middle East, which have been consistent and aggressive buyers of the yellow metal throughout this rate cycle. There was also a brief window of softer-than-expected U.S. economic data that momentarily raised hopes among market participants of a forthcoming Fed pivot. However, subsequent communications from several Federal Open Market Committee members quickly and firmly dampened those expectations. The narrative shifted back decisively towards higher for longer, a phrase that has haunted gold bulls throughout this entire interest rate cycle. Adding further complexity, the broader currency markets are also reflecting this prevailing uncertainty. As Commerzbank noted separately in analysis also published today, the euro itself is struggling to find clear direction against the US dollar, a telling sign that the entire market is in a state of suspended animation, waiting for the Fed's next unambiguous move rather than acting on genuine conviction. So what does all of this mean in practical terms for investors and market participants today, on the 17th of July, 2026? For those holding physical gold or gold-backed exchange-traded funds, the message is one of patience rather than alarm. Gold has not broken down, it has simply stopped climbing. For active traders, however, the stalling rally creates a genuinely tricky environment. Momentum strategies that worked well when gold was trending steadily higher are now generating false signals, leading to choppy and frustrating price action that can erode gains quickly. Institutional investors, meanwhile, are navigating a difficult balancing act. The diversification properties and safe haven credentials of gold remain firmly intact. With geopolitical uncertainties in various corners of the world still elevated, the fundamental case for maintaining some gold allocation has not diminished. However, the carry cost of holding gold over interest-bearing alternatives is real, measurable, and growing harder to justify in the short term. For UK-based investors specifically, the picture is further complicated by sterling's own movements against the dollar, which can either amplify or dilute gold's returns when the metal is priced in pounds rather than US dollars. From a technical standpoint, gold's current pause is occurring at a significant and closely watched level. The precious metal has been unable to sustain any meaningful move above key resistance, and trading volume has noticeably thinned, a classic signature of buyer exhaustion rather than an aggressive new wave of selling. Commerzbank's analysis suggests that without a fresh and compelling catalyst, gold is likely to remain range-bound in the near term, oscillating between well-defined support and resistance levels. The critical variable, as ever in this environment, is the Federal Reserve. Markets are currently pricing in a very limited number of rate reductions for the remainder of 2026, far fewer than many gold bulls had hoped for at the start of this year. Any data release or Fed communication that shifts those expectations, whether it be a surprise in inflation figures, a deterioration in employment numbers, or an unexpected shift in tone from a senior Fed official, will have an outsized and immediate impact on gold prices. On the downside, a further hardening of the Fed's position could push gold back towards levels last seen earlier in the quarter. On the upside, credible evidence of economic softening could reignite the rally that so many investors have been patiently waiting for. For anyone tracking gold closely in the days and weeks ahead, there are 4 specific things to monitor with particular attention. First and most importantly, keep a close eye on any communications from Federal Reserve officials, speeches, interviews, and the minutes from the most recent FOMC meeting will all provide meaningful clues about the direction and pace of U.S. monetary policy. Second, watch the U.S. dollar index closely. Gold and the dollar have a well-established inverse relationship, and any sustained period of dollar weakness would immediately give gold room to breathe and recover. Third, monitor U.S. Treasury yields, particularly the benchmark 10-year yield, which serves as the most widely used proxy for the opportunity cost of holding non-yielding assets like gold. A meaningful and sustained decline in that yield would be directly bullish for the metal. Fourth, keep a careful eye on central bank purchasing data from emerging markets. Nations across Asia, the Middle East, and parts of Africa have been consistent and substantial buyers of gold throughout this period of elevated rates, and any significant acceleration or deceleration in that trend will matter enormously to the supply and demand picture. Looking ahead from today, the 17th of July, 2026, the near-term outlook for gold is genuinely uncertain, and anyone telling you otherwise is either guessing or selling something. Commerzbank's baseline scenario points to continued consolidation, with prices likely to remain range-bound until there is a material shift in the Federal Reserve's posture or a significant deterioration in U.S. economic conditions. The longer-term fundamental case for gold, as a store of value, an inflation hedge, and a counterweight to systemic financial risk, remains structurally intact. Central banks around the world continue to accumulate the metal. De-dollarization trends are ongoing in several major economies, and geopolitical uncertainty shows no sign of fading. What is missing right now is the short-term monetary catalyst that would unlock the next leg higher. When that catalyst arrives, whether it comes in the form of a Fed pivot, a sharp rise in inflation expectations, or a fresh bout of global risk aversion, gold is likely to move quickly and decisively. The investors who will benefit most are those who have maintained their positioning through the current period of frustrating sideways action. So, to bring everything together clearly, as of Friday the 17th of July, 2026, gold's rally has stalled, and the primary driver of that stall is the Federal Reserve's unyielding hawkish stance on interest rates. Commerzbank's analysts have laid out the case with commendable clarity. Gold is not in freefall, but it is not going anywhere fast without a meaningful shift in the Fed's posture or the economic data underpinning it. For long-term investors, this is a moment that calls for discipline and patience rather than reactive decision-making. Gold's role as a store of value and a hedge against systemic risk has not changed. What has changed is the short-term environment, which is demanding a period of consolidation before the next significant move. The rally will very likely resume, but timing it precisely is the challenge that separates successful investors from frustrated ones. Keep your eye on the Fed, watch the 4 signals we identified today, and do not let short-term noise shake a well-reasoned long-term conviction. If you found this analysis useful, please do subscribe for daily market breakdowns delivered in plain, straightforward language.